When you think about a natural disaster, you usually just picture pure destruction, right? Total loss. But what if I told you that hidden inside all that devastation, there's a predictable wave of economic opportunity? That's exactly what we're going to look at today. What happened when a massive flood hit Sri Lanka and how it sent these incredible shockwaves through its stock market, creating a really clear divide between winners and losers. $1 billion. That's the number that really sets the stage here. It's the estimated price tag for Sri Lanka to rebuild after the floods. And yeah, it's a staggering figure, but it's more than just the cost of the damage. What it really represents is a massive amount of cash that was about to be injected right back into the economy. And that leads to this kind of uncomfortable question, doesn't it? When an economy gets hit that hard, can the recovery process itself actually become a source of huge growth for some? That's the paradox we're going to unpack. Yeah, we're calling it the billion-dollar paradox. It's this idea that a single terrible event can trigger two completely opposite effects on the stock market. It's a story of destruction, for sure, but it's also a story about a powerful redirection of money. So how does this actually play out? Well, first, you get the initial shock. That triggers fear. And what do investors do when they're scared? They sell. That's the first tide, a big market slump. But then comes the second tide. That $1 billion in aid, government funds and insurance payouts starts to flow in. And all that money, it has to go somewhere. So this creates what you could call a tale of two tides. It basically splits the economy right down the middle. On one side, you have the sectors that are set to gain, the ones that will literally rebuild the country. And on the other, you have the sectors that are, for the moment, completely underwater. The really crucial point here is that the market often figures this out very, very quickly. All right, let's talk about the winners. Who actually stands to benefit when an entire nation has to be put back together? This is what's known as the rebuilding boom. And when you break it down, it's actually pretty logical. First up, you've got the most direct beneficiaries, the construction and materials companies. We're talking cement, cables, steel, all the stuff you need to rebuild. Then you've got the facilitators, the banks, which are the ones channeling that billion-dollar pipeline of cash. And finally, you have the long-term players, like the insurance sector, which sees this huge surge in demand as everyone suddenly gets serious about preparing for the next disaster. But of course, for every boom, there's a bust. Some sectors don't just miss out on the recovery money, they bear the full, immediate force of the disaster itself. And the immediate pain here is just obvious. Agriculture gets devastated, crops and land literally washed away. Tourism grinds to a halt because, damaged hotels and scary international headlines tend to keep visitors away. And manufacturing, unless you're making stuff for construction, gets hit with a logistical nightmare of damaged factories and broken supply chains. Okay, so this whole theory of winners and losers makes perfect sense on paper. But theories are one thing. The cold, hard reality of the stock market can be something else entirely. So the big question is, did investors actually follow this script? Did the money really move the way we'd expect it to? This is where it gets really fascinating. We're going to dig into the actual data from the Colombo Stock Exchange in the days right after the flooding to see what the market's verdict really was. And just like the theory predicted, that first tide hit hard. On the very first trading day after the disaster peaked, the entire market just plunged. The main index, the ASP, dropped over 3% to a 2-month low. This right here is that widespread panic we were talking about. A sea of red. But here's the thing. If you look closer, even while the broader market was freaking out, something else was happening just beneath the surface. The smart money was already on the move, placing bets not on the chaos of the moment, but on the reconstruction that was sure to come. And this is where you see the proof in the numbers. While the overall market was down, key construction stocks surged. Tokyo Cement, the company you need for concrete, it went up. Kilani Cables, essential for getting the power back on, it shot up. Access Engineering, a major builder of roads and bridges, it climbed. Investors were already buying the recovery before the cleanup had even started. And it wasn't just construction. We see the exact same pattern with the banks. After a tiny initial dip, major players like Sampath Bank and NDB bounced back fast and started to climb. The market clearly understood that these were the institutions that would be managing and profiting from that billion-dollar wave of cash. So, when we step back and look at the bigger picture here, what does all of this really tell us? What's the main takeaway from this tragic but economically fascinating event? Well, it gives us a name for this whole phenomenon, the reconstruction trade. It's a very clear investment strategy. In the wake of a disaster, you pinpoint the companies that are going to provide the essential stuff for the rebuild. And as the market data shows us, it's a very real and very rapid play. So really, what this all comes down to is that a catastrophe like this doesn't just destroy value. It acts as this powerful, if tragic, redistributor of wealth. It violently shifts capital away from sectors like tourism and agriculture and funnels it directly into construction and finance, basically reshaping the entire economic landscape in a matter of days. And that leaves us with one final, pretty sobering thought. This isn't just a story about one flood in Sri Lanka. As climate-related disasters become more and more common all around the world, understanding these brutal economic shifts is going to be more critical than ever. The question is no longer if these tides of recovery will come, but how we all learn to read them when they do.